Hey everyone, welcome back to the Weekend Charts. Charlie Bilello here, and huge show today. As always, I'm going to run through the most important charts and themes that are going on in markets and investing. We're going to discuss inflation, Fed, housing, so much more. So stick around to the end. And as always, if you're watching this on YouTube, hit that subscribe button for more content just like this. So let's start out by talking about inflation. And the big question everyone's asking is the war against inflation over? Market participants seem to be behaving as if it's over, but let's dig into the data a little bit and take a look here at that recent CPI report. So what we saw there is kind of a mixed report in terms of the headline CPI, which includes food and energy, actually ticked up a little bit to 3.35%. That was above expectations. People were expecting 3.2%. But if we look at core CPI, which excludes food and energy, that continued to move down 3.9%. That was the lowest core inflation number since August 2021. And if you dig into the components, something similar here that we've been talking about, with the exception of transportation and shelter, every other major component had a lower rate of inflation in December 2023 than it did back in June 2022 when inflation in the US peaked at 9.1%. So, good news is many components are showing declines and significant declines, and that shelter component, which is still stubbornly high here, is very likely, as we'll talk about in a little bit, to move lower in the coming months. And so if we take out shelter, which is about a third of the index, what we see is actually an inflation rate now that has been below 2% for 7 consecutive months. It's 1.9% year over year. No, this definitely doesn't erase what we saw over here with that huge spike in inflation. But the good news is it's come down. It's now below 2%. And what we should expect in the coming months is shelter will likely join these other components and moving lower. And the reason why I'm projecting that to happen is looking at the real-time data in terms of rents. So this is a chart illustrating U.S. rents here, the blue line, down 1% over the last year versus shelter CPI, 6.2%. So huge gap. And as we've always said here, is just an enormous lag between shelter CPI and the real-time data. And very slowly, it's come down here. This is actually the 9th consecutive month where we've seen a lower shelter CPI number. But again, it's a huge gap between that and the real-time data. So this, in the coming months, I would expect it to come down significantly. And if we compare shelter CPI to rents, actual rents here, for a long time, shelter CPI was understating the increases that we saw in rents in 2021 and 2022. But now finally it's caught up, and actually a little bit more in terms of the cumulative increases since the beginning of 2020. So we're very close, I think, to seeing more significant declines in shelter CPI, and being the biggest component of that index, that should translate into lower numbers for the next CPI report, as we'll talk about in a little bit. So what other signs are we seeing in terms of inflation? Well, we're seeing pretty much all of the other data suggesting inflation continues to cool. Let's talk about producer prices here. 3 straight months below 2%, up only 0.98%, less than 1% over the last year, down significantly, obviously, from the peak in March 2022 of 11.7%. And if we look at import prices here, this is an indication that the supply chains are back running smoothly here. 11 consecutive year over year declines in terms of import prices, down 1.6% over the last year. What about inflation expectations? This is a hugely important factor as well, because when people are expecting higher prices, they become accustomed to it. They're more accepting of it. They don't push back as much, and demand doesn't come down as much. And that becomes, or can become, a vicious cycle. The good news is inflation expectations are actually moving lower in a rapid fashion here. 3% according to the latest New York Fed survey for consumers. That's the lowest we've seen since December 2020. So if it stays there, that's kind of been the normal range before we had the huge inflation spike. What are we seeing in terms of businesses? Something very similar here. Lowest business inflation expectations looking out 1 year since February 2021. So at 2.2% here. So very good news in terms of inflation expectations. And so all of this put together is likely suggesting that the next CPI report, will be much better than what we saw in December. And the early read is that we're likely to see CPI move down to around 3%, maybe even below it. So this is the Cleveland Fed forecast. They do a pretty good job, pretty accurate month after month in terms of predicting what the CPI and core CPI will be. And they're suggesting a little bit below 3%, including food and energy, and the core CPI will continue to move lower down to 3.8%. And the big factor there is going to be that shelter component. So if we see an even bigger decline than people are expecting, that core CPI number could be even lower. And so looking at some of the other components within there, I like to look at used cars, and that continues to trend lower. Positive sign here. Manheim, this is wholesale used car prices. Now, this is the mid-month update for January. And what they're seeing is the lowest wholesale used car prices since March 2021, actually down 22% from the peak. So great sign there. And the good news is if you're looking for a car to buy a used car, you've been waiting for prices to come down, this is a leading indicator of retail prices, which are already moving lower here. Lowest levels for retail used car prices since June 2021. It's a 31-month low, down around 12% from the peak. So, no, it hasn't erased all of these price increases that we saw, but moving in the right direction. And if that Manheim indicator is consistent with the past, we should see in the coming weeks lower retail prices ahead. And if we talk about Tesla here, it's just unbelievable. Stunning declines continue in terms of the average price of a used Tesla, just moving down substantially, 47% below now the peak that we saw back in 2022, and just a stunning decline. So 67,900 was the average price of a used Tesla back then. Today, 35,844. So getting closer to the average used car price in general. Tesla used to have a huge premium over the average used car. Now that premium is closing very fast. So if you've been waiting for EVs to become more affordable, it's happening very rapidly here, and Tesla leading the charge. Number of factors we talked about driving that, and the biggest one is simply Tesla is cutting prices of their new vehicles, and that's translating into lower prices for their used vehicles. Now, interesting headline that I saw here: Hertz, they had made a pretty big transition to try to increase their EV fleet, and now they seem to be abandoning that because of a lack of demand. And also, they're finding the repair costs for these vehicles are pretty high. And also, the fact that we just showed there, the prices of these EVs are going down very significantly. And that's hitting them in terms of having to remark these vehicles, the value of their assets going down very rapidly. So, all that's translating into Hertz pivoting back in the other direction, actually saying they're going to sell off a number of their EVs here at lower prices and actually use some of that to buy regular cars, non-electric vehicles again. So very interesting here. Maybe they got ahead of themselves in terms of thinking they could really expand into the EV space. But there doesn't seem to be enough consumer demand, and there's these other issues in terms of the repair costs and prices going down rapidly. So interesting to see Hertz planning to sell 20,000 EVs. So what is the real-time look at inflation? Well, the Trueflation tries to put a number on that. And as we said, the January CPI number is likely to be around 3%, maybe even a little bit below it. But Trueflation is saying that the actual inflation in the US, what we're seeing today, is around 2.1%. And so their real-time reading is likely reflecting that lower housing inflation number. But we're seeing a number of things in terms of commodity prices coming down, other things as well that are likely contributing to this. And what a difference where we are today versus a year ago. A year ago, this real-time inflation gauge was well over 6%. So huge move lower in terms of inflation here. And we'll see with that January report. We're a little bit more than halfway through January, but it seems to be very likely that we're going to get good news when that report is released in February. So Let's talk about the Fed and how they're likely to react to all of this inflation data. Question that a lot of people will be asking, I think, if the Fed goes along with expectations is, are they about to make a policy mistake in terms of cutting rates too soon? And so let's review here what the Fed is projecting. Well, the Fed is saying they're going to cut rates 3 times in 2024, and the market is saying the Fed is going to do much more than that, that they're actually going to cut 6 times in 2024, and they're going to start those interest rate cuts in March. The odds have come down a little bit in terms of the markets pricing in now 53% probability of a rate cut in March. It was definitely higher than that entering the year. So it's come down a little bit, but still better than a coin flip in terms of the expectations. And this would be very unusual for the Fed to be cutting rates at this point this quickly, given the fact that the employment market, their other mandate, is still very good. So it's unusual for to see a Fed cutting interest rates when you have an unemployment rate at 3.7%, jobs still growing, and you also have now the stock market back at an all-time high. And so this is the first all-time high for the S&P 500 since January 2022. So it took 2 years to recover from this bear market, but now finally S&P prices back at all-time highs. So financial conditions obviously pretty good as well. And what I would say the bigger question is in terms of the way Powell had been talking prior to the December meeting was he was going to fight the inflation fight until the job was done. And to me, that job isn't done until you bring prices back in line with what the trend was before we had that inflation spike. So famously, Powell had this speech back in August 2020 when there were fears of a depression and they were saying inflation's too low and that they would allow the inflation rate to remain above 2% for a period of time so that the average would average out to 2%. And so if you apply that same logic today, what I would say is, well, we should have a period where inflation is below 2% for a period of time to allow prices to come back down to that long-term 2% trend. If the goal is to target 2% inflation, just moving back down to 2%, which we're not even there yet, we're only at 3, we're still above 3%, that doesn't do it. That doesn't erase it. We're still 10% above that trend because of that enormous price increases that we saw in 2021 and 2022. So we're at 3% now. We're likely to continue to trend lower in the coming months. And what Powell said in December is he doesn't want to wait until we get to 2% before he starts easing policy. He could start thinking about cutting rates before that point. And what I would say is if you're going to be an inflation fighter and you don't want to run the risk of making a policy mistake here, if your true intention is to bring prices back down, then you would keep restrictive policy for longer here and you wouldn't start cutting rates in March. So we'll see what happens here. A lot can change between now and March. Perhaps they'll push that back to May. Certainly, if we get firmer inflation data, that will be likely. And obviously, we'll get another employment report before then as well. So we'll see what that data suggests. So a lot could happen between now and then. But in my view, the Fed, there's really shouldn't be any urgency to start cutting rates yet, given the employment data, given the overall data, given the stock market back at new all-time highs. So if they are truly concerned with inflation, as they've been saying they are, then why not leave a tighter monetary policy for longer? Because it appears to be working. We showed that chart of used cars there and other areas as well. Any area where interest rates are a factor and consumers are having a harder time borrowing, well, that's going to impact demand and that's going to allow for prices to come back down. So we'll see what happens there. But in my view, Fed would be making a mistake to cut early at this point. And if they truly want to bring down inflation, keep the restrictive monetary policy. But overall, you know my view at this point, the Fed and human beings shouldn't be determining a interest rate for the entire economy. That's a mistake. They've gotten it wrong time and time again. I don't think I could say what the Fed funds rate would be any better than the Fed. I just would I would have a tendency to let the data drive it more than the Fed does. So I certainly wouldn't go back to 0% interest rates. If we're going to have human beings involved in trying to set interest rates, use some type of formula, some percent above what CPI is, and just use that as a gauge instead of just kind of throwing darts saying sometimes it should be below CPI, sometimes it should be above it, and trying to manage the economy. To me, that goes against what capitalism is all about and free markets are all about, suggesting that a group of people sitting in a room can determine what the interest rate should be better than the free market. But again, that's my view. That doesn't seem to be likely anytime soon. People are still suggesting that the Fed should have this type of power. So let's talk about other reasons why the Fed might be cutting interest rates, even though it may not be necessary. Well, the national debt continues to be front and center, continues to be a big issue here. And there's likely to be some pressure on the Fed to say, we have all of this short term debt, and you can help with the interest expense by bringing that interest rate down. 961 billion, another record high in terms of what the interest expense is on the national debt. And if it continues at this pace, it's quickly going to be the largest line item in the budget. So certainly the Fed, even though they say they're independent, certainly this is in the back of their minds and saying, well, how long can we keep interest rates this high given this predicament? And if we look at the deficit here, again, highly unusual. We have a unemployment rate at 3.7%, and we have a deficit of nearly $2 trillion. So this situation is not going to get better because you're adding new debt. And unless interest rates come down significantly, the interest expense keeps getting higher and higher. So something I think as we get closer to the election, it's going to be more front and center as this kind of builds here. And the big question is, are they going to keep running $2 trillion deficits with an economy in expansion? Because if that's the case, then when that recession comes, and there will be, of course, another recession, are they going to expand it to 3 trillion or 4 trillion at that point? And that seems pretty likely if they're doing this when economic times are good. So let's talk about the housing market. And this has kind of been a story that repeats itself. If you remember the movie Groundhog Day, where the same thing happens to Bill Murray every single day, this has kind of been the story for the housing market over the past year. It's just an absolutely deep freeze and absolutely the lowest activity that we've seen in a long, long time. If we're looking at existing home sales, and this is looking at monthly data annualized, we got the lowest in December since August 2010. And what the National Association of Realtors said was for 2023, it was the lowest number of home sales since 1995. So just incredible to see. Obviously, population much bigger today. All else equal, you would expect higher levels of home sales, but just a collapse in terms of activity. And just reviewing the reasons for that, the biggest one being very little inventory and very low affordability. And why is there very little inventory? Well, most people who have a mortgage today have an interest rate that's much, much lower than where the market rate is today. So we have mortgage rates still above 6%, but 90% roughly of mortgage holders have interest rates below 6%. I think around 60% have an interest rate actually below 4%. And frankly, these people are not going to give up that mortgage rate and try to buy a new home because it's either unaffordable or they're in a financial situation then where it's going to be much more difficult. So they locked in these low interest rates. For now, they're staying put, they're not moving, and that creates a very limited supply situation. And the fascinating thing, what we saw in 2023, is this actually led to higher prices. So even though the demand side had an absolute collapse, there was very little people looking to buy a home. Even though that part saw a collapse, we saw supply come down even more, and that translated into higher home prices in 2023. So we're seeing median home prices in December of 2023 up 4% year over year, according to Redfin. And all comes back to this affordability number in terms of how is this going to change this freeze. And to me, unless this meaningfully changes here, you're not going to see a big change in that deep freeze, because people simply can't spend this much as a percentage of their income in buying a home. So the median home that's priced for sale today, it would take 45% of the median income to afford that home. And that includes P&I, taxes, insurance. And that is unaffordable for most people. That doesn't leave room for anything else. Pretty much, you can't save anything. You can't go on vacation. All you're doing is putting everything into that house payment. It's actually higher in terms of a percentage of income than what we saw during the housing bubble of the 2000s. So just extreme low levels of unaffordability. And the only way that changes in the short run is if home prices come down or mortgage rates come down. And so far, as we showed, home prices still going up. Good news on the mortgage rate number, it's actually starting to move lower here. So we peaked at 7.79% last October, and now we're down to around 6.6%. Is this enough to make a huge change in terms of affordability? No, but it's something. And if it continues to move lower, that would certainly help. The easier way, of course, would be for prices to come down. And that's going to be necessary. Even if we have mortgage rates at 6%, this affordability picture is still very, very difficult, just because how much prices went up over the last few years. So if we're looking at building, this is the other way that would be helpful. You get more supply. Housing starts still kind of stagnant. Population in the US up 90% since 1960. We have the same number of housing starts. And no, this shouldn't be one for one. Obviously, multiple people occupy a home, but it should be higher today than it was back in 1960. And we're just not seeing that. And so the expectation is we're going to need a building boom in the US. It's simply any type of analysis that you read, there's a deficit, varies from analysis to analysis, but I've seen 2 million homes, 5 million homes, 10 million homes. There's a deficit of homes in the US. And the expectation is that we're going to see more building in the years to come, that this is a secular trend until that deficit is closed. And the market has been, of course, forward looking in terms of predicting this. Looking at that home builder ETF here over the last 5 years, up 184% versus a 96% gain for the S&P 500. So the expectation is home builders, and they've seen their profits go way up over the past few years. You look at any one of the home builders in this XHB ETFs, huge increase in profits over the past few years. And the expectation, at least if you're looking at market prices, is that's going to continue, high profitability. And I guess simply there aren't enough home builders around because of that 2008 financial crisis. Many of them went out of business. The sector itself lost a lot of workers, and now there's simply a shortage. And that's a good situation, very good situation if you're a home builder today, because you have very fat profit margins until new entrants come in, until there's more home builders competing. They're in a very, very good position. And again, secular trend, hopefully many more homes are going to be built in the next 5 to 10 years to try to close that deficit. And that would certainly help with prices. So let's talk about the consumer and retail sales. This was a trend going on for over a year, where we were talking about lower retail sales on an inflation adjusted basis. So if you look at this bottom panel here, we had seen negative year over year inflation adjusted retail sales since October 2022. And finally, we had been trending up in the past few months, but finally we saw a positive number looking at December for US retail sales on an inflation adjusted basis. And we saw nominal retail sales tick up to a little bit above the historical average, up 4.78% year over year. So it seems like the consumer, who was in a pretty bad place there with that high inflation, with their wages not keeping up with inflation, they had pulled back in terms of their spending. But that's changing as their wages, and we'll talk about this later, are outpacing inflation now. The US consumer is coming back and spending again. And interestingly, consumer confidence is one of the things that is usually a contrarian indicator. And it was once again here, it hit its lowest point in history in 2022, right around where the market kind of bottomed. And now obviously we're back at all-time highs for the S&P. So once again, pretty good contrarian indicator in terms of buying the market when this is low tends to be pretty good, and being more skeptical of the market when this is high tends to be show the opposite. But we had a record 29 straight months below 75 for this University of Michigan Consumer Sentiment Index, and that was the even more than what we saw during 2008 to 2010 during the financial crisis and an actual recession, and a deep recession. I think was the worst recession since the Great Depression. And so 29 straight months below 75. And January, we just got the reading today, and what it showed was a pretty sizable spike up here, 78. And so we're finally out of that ultra low territory. That's the highest reading now since July 2021. So why are consumers feeling better? Inflation's coming down, number one reason, and their wages are continuing to go up, as we'll talk about at the end. So capitalism versus communism might seem obvious to anyone watching this that capitalism is a better system. But if you went back 10 years, a lot of people were saying, well, China seems like they're doing pretty well. They have all of this tremendous growth. They're able to get things done quicker. They're building cities and they're building bridges in record time. And their population is benefiting from this commerce. And so what that they don't have all the freedoms we have today? They have a little bit of freedom, and that's enough. Well, that has changed. That perception that a little bit of freedom is okay has completely changed today. If we look at the last 10 years, this will tell you the reason why here. S&P 500 technology ETF up 509%. China technology ETF down 11%. So all of a sudden, people kind of realizing, well, maybe this system isn't working out. Maybe we can't trust the data of these companies because of what happened in 2020 in terms of Jack Ma and his disappearance and constant interference in terms of the government saying this company has gotten too big, this person has gotten too powerful. And when you put that kind of situation into the market participants say, well, this is a real risk here. This is not like a company in the US where we could trust the accounting, where we can trust that the government isn't going to come in and tell this business they can't do that anymore, or they have to share with the greater good, which is what they said with many of these companies, or that the fact that simply that the profits that they're making were too high. So that's something that in the US would be unheard of. In China, it's kind of commonplace. And so we've gone a completely reversal from where we were a decade ago to where we are today. It's not just the technology sector. The overall China large cap ETF down 23%. S&P 500 has tripled over the last 10 years. And really, it's kind of remarkable. September 2014, there was a lot of excitement surrounding the Alibaba IPO. You had Jack Ma down at the exchange. It was just a great personal success story for him. Came from nothing, rose up to start this company. And for a number of years, Alibaba did pretty well as a public company. Profits were going up, revenues were going up. And then October 24th, 2020 happened, and Jack Ma gave this speech criticizing China's policies, regulations, state-owned banks, and all of a sudden he disappears. It coincided really with the peak in the stock, and since then he did resurface a few months later, but never made any comments like that again. It's not even clear what actually happened to him in terms of what they said to him, but clearly Alibaba, not the same company today, gave back all of its gains, and it's actually trading at a lower price today than it was trading back on the first day of its IPO. So 27% lower than that first day close. The NASDAQ 100 ETF sitting here at an all-time high, at the same time up 349%. since that first day of trading. So that's remarkable to see the sentiment shift. And in 2020, it wasn't just this situation with Jack Ma that had people change their opinion. I think in terms of China, it was just all of the other things surrounding COVID. We got to see firsthand how they were treating their people there, really just disastrous conditions, locking people up and not letting them out of their homes, lying about the number of people that had died of COVID, not letting us investigate the origins of COVID, which now seem very likely that originated from the lab in Wuhan. So all of these factors suggest that a lot of the data that's coming out of China, you can't trust it. And what I've said for years is that the China GDP numbers just don't square with reality. You have this situation where they're saying GDP is going up 6, 7, 8% per year for over a decade. But if we look at the actual corporations and their profits, they don't reflect anywhere near that type of growth. So where is all of that supposed economic growth going if it's not going into the corporations? I don't know the answer to that. I don't think anyone does, but I think the right way to approach this is to be skeptical, very skeptical of anything that comes out of China in terms of their data points. So I used to put an asterisk next to everything that China reported, saying pretty much don't trust any of the data. All of the Chinese data is likely fabricated, as you would imagine. If you have someone in power, it's not elected, they want to stay in power, well, they're going to cover up anything bad that's going on, just like they did during COVID. They're going to do the same in terms of their economic statistics. And it doesn't make any sense that with all of the problems today in China, in terms of, we know there's a slowdown there, we know there's high youth unemployment, we know that there's a recession in terms of their housing market, does it really make sense that their real GDP is still growing above 5% when the US GDP is around likely 2%? That doesn't really make sense whatsoever. So the fascinating thing from an investment standpoint is the sentiment on Alibaba has totally changed from where it was trading at just a ridiculous multiple at its IPO at over 20 times sales. And today it's trading at a 1.36 price to sales ratio, which was actually lower now than Campbell's Soup. So consumer staple company with very low growth, actually lower. Alibaba's actually lower on a multiple of sales than Campbell's Soup. So the question, I guess, would be, has sentiment got too low? Yeah, probably. But the question would be, well, what's going to turn this around? The only thing that's going to turn around is some positive news, some assurance from the government in China that all the things that we've talked about are going to change and start moving into the right direction. That could happen at any point, and hopefully it does. But there's very little way you can handicap if and when that's going to happen. And in terms of demographics in China, and this is something that they're trying to reverse, which is kind of ironic because they had for a long time the one-child policy, where essentially you weren't allowed to have more than one child, and if you broke that rule, there were severe consequences. And now today, if you read what's going on in China, they've completely flipped to say they're trying to encourage people to have children. They're using all sorts of propaganda to try to do that, but it doesn't seem to be working. The people there don't seem to be wanting to have or bring children into that society. And you have 9 million births in 2023, which is the lowest on record with data going back to 1949. Actually saw a population decline in China of 2 million people in 2023. And the fertility rate, which is the number of babies a woman is expected to have in her lifetime, actually moved down to 1 in 2023, another record low. So huge implications if this were to continue. Certainly not obviously good for economic growth, but there's many other societal problems, obviously, that this brings about with an aging population and not replacing that with younger workers. So China has a host of issues, and the market, as you might expect, is pricing many of these issues in. So this is looking at the CAPE ratio in the US versus China, valuation ratio 32 for the US and 10.5 to China. And what a reversal from where we were only a little bit a decade ago, they were at parity. If you go back to '07, when you just had this mania in China and rush higher in the Chinese stock market, it was trading at just ridiculous multiples as compared to the US. And now completely reversed. You almost have 3 times the valuation multiple. So the interesting thing for investors is, well, this could this could turn around. This could be a valuation opportunity, but the only way you could say that with any level of certainty is if you think the conditions in China and the regulatory issues and the other issues that we've talked about are going to start moving in the other direction. Otherwise, perhaps this multiple is the right multiple, or perhaps even it's too high. And then you have, of course, the tail risk situation that I talked about last year and the year before of the Taiwan, and what would the US do if China went into Taiwan? Would they do something similar to what they did in terms of Russia, essentially eliminating it from marketplace, not allowing US investors to buy Russian stocks, and the implications of that? That may be a very low probability event, but it's not zero, and certainly weighing on the markets as well. Now, what if you're a global investor and you just buy a global index? Is how important is China? I think this is reassuring. China is now a very small part of the overall market. This is the Vanguard Total Market ETF, the country weights here. China now, same as Canada, 2.8% of this. The US sitting here at 61%. Japan, twice as big as China. So even if China were to decline a lot from here, if you're a globally diversified investor, not going to likely have a big impact. And if China reverses course and starts to increase freedoms, and hopefully they do that, well, you'll benefit from that, and China will have a higher weight. So as Americans, we're all should be rooting that China moves more closer to us and becomes a more free society, and we just have an increase in prosperity for the Chinese people, similar to here. That may seem like a low probability event today, but it's not zero all as well. It's not totally hopeless there. So hopefully that does happen. But as an investor, what I would say, seems to be a very binary situation and very hard to handicap. We know sentiment today about China almost couldn't get worse, and most of the time that occurs near some type of low. And so there will be a rally likely in Chinese stocks again. The question for long-term investors is, can you trust it? Can you trust the data? And this system of communism with a little bit of capitalism, is that enough to create long-term profitability for these companies anywhere near what's going on in the US? And the answer over the last 10, 20 years now has been no. So let's talk about the Bitcoin ETF, which was finally approved by the SEC, and they approved a whole bunch of them. I listed them here. You have the Bitwise Bitcoin ETF with the lowest expense ratio at 0.2%, and a number of them are waiving fees for a period of time as well. So you won't be paying any management fees. Why did the SEC take so long? I think that's the big question to approve this, when they had a Bitcoin futures ETF for a while. They had, of course, many crazier products in terms of volatility and leveraged trading of any type of thing, 3x ETFs. That I don't know. It didn't make sense to me. It didn't make sense to most rational people. But SEC finally reversed course, approves the spot Bitcoin ETF. And the fascinating thing from a sentiment standpoint is the fact that Bitcoin once again ran up in price ahead of this announcement, ahead of this approval. And this is really now the third time we've seen something like this, because back in December of 2017, you had Bitcoin futures start trading, Bitcoin peaks in price, then you had an 80% price decline. In October 2021, you had the first Bitcoin futures ETF approved. It peaked a little while later, I think in November 2021. And then you had a close to 80% decline. And now, ahead of this approval for the spot ETF, you have a peak in Bitcoin once again, and we don't know what will happen this time around. But so far, we've seen a little bit of a sell off. So just interesting to see euphoria surrounding these three events and then a sell off. And what I like to remind people, we're thinking about Bitcoin, is study the history, and the history suggests that you need to be prepared for a lot of volatility and a lot of drawdown. So all of the upside that you've seen in Bitcoin, and it's been obviously the best performing asset over the last decade, and that did not come without huge declines here, showing many times 30, 40, 50, 60, 80% declines from peak to trough, most recently being that peak close to 69,000 in November 2021 and a 78% decline after that. In terms of volatility, this is not like a stock investment and certainly not like a bond investment. The volatility is much higher than traditional vehicles. And you're looking at, even though volatility has come down to about 45% annualized over the past year, that's still multiples higher than what something like the S&P 500 is, around 15% volatility historically. So certainly not a position for the faint of heart. If you're thinking about Bitcoin, you have to be prepared to withstand huge amounts of volatility, and there's no such thing as upside without downside. So fully expect these types of corrections along the way. So wages outpacing inflation. I want to end, as we always do, with a positive story here. And this is an extremely positive story for everyone in America. The fact that inflation has come down to the point where your wages are going up more than inflation. That's pretty much the definition of prosperity for a nation. And we're back in that camp. And we've been in that camp now for a number of months. So let's just run through it here. We have food price inflation down to 1.3%. This is, in my view, the single best data point in that recent CPI report. That's the lowest food price inflation since June 2021. And as I've said, and I'll say it again here, I would love to see this go negative, as it did a number of times in the past. So food prices would actually come down on a nominal basis. That wouldn't be the worst thing at all. Hopefully, this continues to trend lower. If we're looking at apartment prices, we talked about rents coming down year over year. So that's huge. And we're looking here now at a period of time, almost a year and a half, where apartment prices have not hit a new high. So over that period of time, the good news is wages have continued to go up. So whereas the housing market is becoming less and less affordable, apartments are becoming more and more affordable. That's great news. And if we look at gas prices here, $3.07 a gallon. That's the lowest since June 2021, down year over year. So that should be another positive contributor for CPI in January. And the big thing here is obviously that wages continue to push higher, even though the labor market has definitely normalized and continues to normalize. There's still obviously demand for labor, and that demand is causing companies to increase wages. 4.1% increase in average hourly earnings over the past year. That was above expectations of a 3.9% increase. And the important thing, obviously, is that inflation, even at that 3.3% level, well, that's below the level of wages, and that spread is really what historically has led to an increase in prosperity. So now we have 8 consecutive months where wages have outpaced inflation. Just a hugely important thing for the American worker. And hopefully this continues. It definitely will continue again for January if we get that 3% CPI report. But hopefully this continues for a long time, and we don't go back to the situation where wages are lagging and under the rate of inflation. So with that, I'll end it right there. We covered a lot of ground today. Thank you, as always, for joining me on the Week in Charts. If you like the content, subscribe to the channel. Have a great weekend, and I'll see you next time on the Week in Charts.